Imperial Bank was the most quietly dangerous bank in Kenya's history.
The Central Bank of Kenya, CBK, has given the nod for the liquidation of Imperial Bank, paving the way for the sale of its assets.
Not because it was the biggest, not because it was the most powerful, but it was the last anyone expected to fall.
Pay us some money. There are some depositors who are really suffering. They have no money for medical bills. They have no money for school fees. This is ridiculous.
For years, Imperial Bank operated in near silence, tucked away from media attention and political scandals. It wasn't the kind of institution that drew headlines or controversies. Clients described it as efficient, personal, and conservative, the kind of place you will trust with your children's education fund or your family's business savings. But what no one could see, or perhaps choose not, was that a financial time bomb had been ticking at its core for more than a decade. Behind the scenes, a carefully orchestrated fraud worth over 20 billion Kenyan shillings was unfolding right under the noses of regulators, auditors, and the public. When the truth finally emerged in 2015, thousands of depositors were locked out of their money, lives shattered, trust in banking system was shaken. This is not just a story about a bank. It's about blind trust, hidden power, and the cracks in Kenya's financial system that no one wanted to talk about until it was too late. But before we continue, if you find this video interesting, make sure to like and subscribe for more captivating stories. Imperial Bank was established in 1992 in Nairobi, Kenya, initially under the name Imperial Finance and Securities Company Limited. It began as a non-banking financial institution, focusing primarily on offering hire purchase and leasing services to a niche clientele. It was founded by a group of entrepreneurs and financiers, including Abdul Malik Jan Mohammed, who would later become the managing director and central figure in the bank's growth and eventual downfall. By 1996, 4 years after its formation, the institution's leaders were ready to scale. They applied for and received a commercial banking license from the Central Bank of Kenya, officially transitioning into Imperial Bank Limited. The rebranding marked a turning point. Imperial Bank could now accept deposits, issue loans, and offer a full range of banking services to the public. Imperial Bank's core mission was focused on serving SMEs, a strategy that was both bold and unconventional in the 1990s. While most banks viewed small businesses as risky and unprofitable, Imperial Bank recognized their potentials. Its products offerings were built to cater to traders and wholesalers, family-run businesses, professional service firms, and individual entrepreneurs. The bank offered relatively lower minimum balance requirements, faster loan approvals, and a banking experience that emphasized the relationships over red tape. Over time, this approach created loyalty and trust, two assets that would fuel Imperial Bank's expansion. With Nairobi as its base, Imperial Bank began operating branches in major commercial hubs: Mombasa, Kisumu, Westlands, Eastleigh, and the industrial area in Nairobi. Despite its relatively small size, the bank operated efficiently. It chose strategic locations where SMEs thrived, ensuring it could reach its ideal customer base with minimal overhead. Behind the steady growth of Imperial Bank was one man, Abdul Malik Jan Mohammed. Polished, calculating, and always in control, Jan Mohammed had been part of the bank since its earliest days. As managing director, he didn't chase headlines. Instead, he curated a brand of silence, seriousness, and control. Under his leadership, the bank never made a scandalous headline. It made profits. To the public, the numbers spoke for themselves. For over a decade, Imperial Bank posted steady growth. Its balance sheet ballooned to over 58 billion Kenyan shillings. Its return on equity remained strong, and its loan book was seen as one of the cleanest in the industry. Investors took notice. So did depositors. Slowly, Imperial Bank became the go-to financial partner for a generation of SMEs and middle-class professionals who didn't want the chaos of big banks or the volatility of newer digital entrants. Imperial Bank's branding was almost invisible. No radio jingles, no television ads, no roadside banners, just clean, professional fonts, a calm blue logo, and a motto that emphasized values like trust, relationship, and stability. Instead of advertising, the bank relied on word of mouth. A hardware in Kariobangi would recommend it to a cousin importing tiles from China. A garment trader in Gikomba would refer it to a clearing agent at the port. Trust spread like ripples in water. The bank occasionally sponsored Islamic finance breakfasts, but always with restraints. It wasn't interested in everyone. It was interested in the right ones. Regulators at the Central Bank of Kenya viewed Imperial Bank as a quiet success story, a conservative lender posting profits with no history of liquidity trouble. Its audited accounts checked out, and its capital ratio were healthy. There were no reason to worry. Internally, the bank was privately held with family-linked shareholders, a small board of directors, and trusted professionals around Jan Mohammed. There were no activist investors, no shareholder drama, and foreign interference. But beneath the surface, something else was going on. Abdul Malik Jan Mohammed was at the center of the bank's operations. He didn't just run Imperial Bank, he was Imperial Bank. Everything passed through him: credit approvals, risk assessments, even staff appointments. There were formal committees and a board of directors, yes, but in reality, they were kept at arm's length. Jan Mohammed crafted the reports. He set the tone. He controlled the narrative. Inside the bank, few questioned him. Those who did either found themselves quietly moved aside or left the organization altogether. Over time, an internal culture took root, a culture built on silence. Staff at Imperial Bank will tell you, even now, that the work culture was strange. People whispered about strange loans, strange clients, and stranger instructions. But no one spoke up. You didn't ask questions, you followed orders. Some employees had seen transactions that didn't quite add up, but they said nothing. Fear hung in the air, not from direct threats, but from something worse, a quiet understanding that some things were too dangerous to uncover. One former staff member described it as like walking inside a house with no windows. You just hope for the roof wouldn't fall in. Unknown to the public and the regulators, a second bank existed inside Imperial Bank. Jan Mohammed, together with a smaller inner circle, was running a shadow lending operation. For over 13 years, they extended loans worth over 34 billion Kenyan shillings to a group of handicapped clients, many of them shell companies or insiders. These loans didn't go through the bank's official systems. They were recorded manually outside of Bank Fusion, the core banking software. The official system showed one version of the bank. The real version was hidden handwritten ledgers, private spreadsheets, and secret instructions. Some clients were given massive loans without collateral, without paperwork, and without payment schedules. And when one loan looked like it might default, a new one would be issued to cover it. It was a house of cards, and it was growing taller every year. Year after year, external auditors signed off on the bank's accounts. The Central Bank of Kenya saw nothing alarming. Imperial Bank wasn't aggressively expanding like Equity or KCB. It wasn't loud, it wasn't risky, it looked safe. And that's what made it dangerous. No one looked too closely because the numbers looked good. Regulators trusted the data, but the data had been sanitized. The fraud worked not because it was sophisticated, but because everyone trusted the facade. Until one day, the man who held it all together was gone. On the morning of September 15, 2015, the Kenyan banking world was jolted by the sudden death of Jan Mohammed, the long-serving managing director of Imperial Bank. At first, the news was received with solemnity, but within days, his death will trigger one of the biggest financial scandals in the Kenyan banking history. As Imperial Bank's board and senior managers began reviewing operations following Jan Mohammed's passing, they stumbled upon anomalies, unauthorized loans, hidden accounts, irregularities in credit disbursement. What began as internal curiosity quickly turned into alarm. In early October, just a few weeks after Jan Mohammed's death, Imperial Bank was placed under receivership by the Central Bank of Kenya. The official explanation was unsafe banking practices. But the true magnitude of the fraud was only beginning to surface. A forensic audit by KPMG revealed an astonishing level of deceit. Over a period of 13 years, approximately 34 billion Kenyan shillings, roughly $340 million, had been siphoned from the bank through unauthorized disbursement orchestrated by Jan Mohammed and a network of insiders. The fraud had been well planned and meticulously covered up. It involved fraudulent overdrafts, manipulation of core banking systems, and fictitious transactions routed through ghost accounts. Some funds were used to pay off other loans in a classic Ponzi-style cycle, while others were allegedly used for personal enrichment and business expansion linked to well-connected individuals. KPMG noted that the operation had been impossible to carry out without the collusion of senior staff and potentially the blunt eye of regulators. The collapse of Imperial Bank caused panic across the country. Customers who had trusted Imperial Bank with their life savings were met with shattered branches and frozen accounts. Long lines formed outside branches as rumors swelled. Some customers were denied access to medical treatment, school fees, or business operations as their funds remained locked. The media erupted. Headlines blurred like banking scandal of the decade and how 34 billion Kenyan shillings vanished. The scandal was made worse by the fact that Imperial Bank had just 2 months earlier issued a corporate bond of 2 billion Kenyan shillings, which was now in limbo, burning investors who had brought in on faith. The scandal rocked public trust in the banking sector, especially given that Imperial Bank was considered among the most stable mid-tier banks. Depositors in other institutions began to ask uncomfortable questions. The CBK, under their new governor, Dr. Patrick Njoroge, moved swiftly to contain the damage. Along with the Kenya Deposit Insurance Corporation, KDIC, they placed the bank under statutory management. Investigations were launched. Assets of implicated directors were frozen and a limited schedule of repayments to depositors began, although most only received a fraction of their money. CBK would later allege that certain audit firms had failed in their responsibilities over the years. Lawsuits were filed. Investors in corporate bond demanded justice. The Imperial Bank scandal triggered a broader crackdown on rogue banking practices in Kenya. It was followed in close succession by the collapse of Dubai Bank and Chase Bank, raising fears of systematic instability. CBK introduced tighter supervision rules, more scrutiny of brand practices, and enhanced transparency measures. Imperial Bank had quietly become one of the top financiers for small and medium-sized businesses in Kenya. It gave overdrafts to hardware suppliers. It financed LPOs for small contractors. It offered working capital to agribusiness startups. Many SMEs had built entire business model around Imperial's support. When it went down, credit lines vanished, checks bounced, orders were cancelled, and some businesses went bankrupt within 48 hours. Esther, who ran a stationery supply company, watched her 3 staff walk out as she faltered to pay salaries. She said, and I quote, "I wasn't a fraudster, I was just caught in someone else's mess." And as other banks grew more cautious, credit dried up for the entire SME sector. What was once the backbone of Kenya's economy suddenly found itself unbanked and unsupported. In 2016, CBK and KDIC filed a 45 billion Kenyan shillings lawsuit against Imperial Bank's former directors, shareholders, and beneficiaries of the fraud. The goal was to recover looted funds and hold those in positions of authority personally liable. Some directors insisted they were unaware of the fraud and were deceived by Jan Mohammed, who allegedly kept 2 assets of books. Several cases are still in court, unresolved years later due to complex asset tracing, appeals, and legal delays. Some out-of-court settlements were reached with minor shareholders. Efforts to recover assets and freeze accounts in Kenya and abroad faced jurisdictional hurdles. For more Kenyans, the scandal became a symbolic of a justice system that fails to hold powerful people accountable. Nearly a decade later, billions remain uncovered. No one has served a jail term, and many depositors still haven't seen their full funds returned. Today, Imperial is gone, its name scrubbed from the skyline, its branches closed, its legacy a cautionary tale. The fall of Imperial Bank taught Kenya something priceless and painful. When the trust becomes blind, systems break. But when lessons are learned, they don't have to break.